Hi everyone, and we are now going to review the practice problems for chapter 14. And actually, this is my second attempt doing this, my first one. It didn't record. So I'm on the wrong page. Yes, 531. We're going to be looking at problems 14.1b and 14.2b. So we have Romero issues $3.4 million, 10%, 10-year bonds dated January 1, 2019 that pay interest semi-annually on June 30th and December 31st. The bonds are issued at a price of $3,010,000. Now, the reason they are sold for less than their face or principal is because the date of the sale, it doesn't tell us this, but I know that the date of the sale, the market interest rate on bonds that are similar to Romero's are selling with an interest rate higher. And it's just because of the way they decided to sell them. It's just that the majority of other corporations have a higher interest rate. So the market rate is higher. The 10% is written in stone. They decided that a few months ago. So Romero can't go grab some whiteout and start changing numbers on their bond certificate. So they're stuck paying that interest rate. So to entice people to purchase their bond with that lower interest rate, they sell it to them for less upfront. So what does this mean to the bondholder? Well, the bondholder is going to pay $3,010,000 and in 10 years receive $3,400,000. So they're loaning only $3,010,000. They'll be getting interest over the life of the bond and then get extra back when they receive the repayment. And that's how the corporation makes up for the difference. So the difference in that selling price is really interest. It's caused because the contract rate of interest on the bond that's being sold here and the market interest rate for other bonds similar to it is different. And in this case, the market rate is higher. So we debit the difference to the discount on bonds payable account, which remember is a contra account. It's a contra to bonds payable. We always credit bonds payable for the principal. Now, the next part wants us to determine first how much cash interest is actually going to be paid each interest payment date, June 30th and December 31st. Take the principal of the bond, not the selling price, the principal, because the principal is what we promise to pay interest on. That's what our contract says. 3.4 million times the contract rate of interest of 10% twice a year, so 6/12. So $170,000 is the cash the company will actually pay. Also, they get to now recognize some of that lump sum interest, the discount, each interest payment date. So they divide it equally. Of the $390,000, there's 10 interest payments. Or I'm sorry, 20 interest payments. It's a 10-year bond twice a year. So each interest payment date, they're going to move some of that discount on bonds payable out of that account and put it into interest expense. So the bond interest expense will be the actual cash they're paying out plus that lump sum payment they're going to make at the end, that extra $390,000. They're actually recognizing that as interest expense throughout the life of the bond, not at the very end. So let's see the journal entry. So on June 30th, bond interest expense will be debited for the total of the cash and the portion of the discount will recognize as interest. Credit the discount on bonds payable because we moved that much out of the discount on bonds payable account, and then credit cash, of course. Notice the journal entry for December 31st is the same exact thing. Still paying cash of $170,000, still moving over $19,500 of that discount on bonds payable and debit interest expense for the total. Now, In part 3, they say, what's the total bond interest expense that will be paid over the entire life of the bond? Well, the interest payment is $170,000 for 20 interest payments. So 170,000 times 20 will give us 3.4 million, which just so happens to also be our face value of our bond. That's a coincidence. How much discount did the company provide to the bondholder? 390,000. So the corporation said, we'll take $390,000 less when you sell us the bond, or I'm sorry, when you buy the bondholder, and we'll pay you that extra at the end to make up for those interest rates differences. So the total actual amount of interest that is paid out over the life of the bond is $3,790,000. Now, as far as carrying value, which is part 4, carrying value is always determined by taking the face value of the bond, and if it's a discount, subtracting the discount. So the face value of this bond is $3.4 million. The initial discount on bonds payable, or what we call unamortized, not expensed discount, is $390,000. So 3.4 million minus 390,000, you get $3,010,000. On June 30th, if we were to find the carrying value, remember, each interest payment date, we're reducing the discount on bonds payable account. We're crediting it. So subtract 19,500 from that 390,000. Now you have $370,500. 3.4 million face value minus 370,500 unamortized discount gives us carrying value of 3,029,500. On December 31st, again, the next interest payment date, we're reducing the discount account by another 19,500. So subtract that from the 370,500, the current balance in the discount on bonds payable. Now we're down to 351,000. If we subtract that from our face value of 3.4 million, now our carrying value has increased through 3,049,000. Notice our carrying value keeps increasing by 19,500. Yeah, because we're subtracting less discount after each interest payment. So that when we're done with our last interest payment, unamortized discount will be 0. We have now recognized all that discount as interest expense, and the carrying value of the bond will be at $3.4 million. So when we sell a bond at a discount, it is sold that way because the interest rate on our bond is less than the market interest rate. And to make up for that difference, we sell the bond for less. We store that difference in the discount on bonds payable. Each interest payment date, we not only pay the cash we promise as interest, but also recognize a portion of that discount as interest, giving us total interest expense. That will help us to create our journal entry to record the actual interest every 6 months. Debit bond interest expense, credit the discount on bonds payable account, and credit cash. Now let's take a look at 14.2b. In 14.2b, we're going to have the same scenario, except one thing changes. Now we're selling the bond for more than its face value. We're selling it for $4,192,932. So debit cash for the total amount we sold it for, credit bonds payable for the face value. The difference, since we sold it for more than its face value, is what we call premium on bonds payable. We sold it for more than its face value. Why did that happen? Because our interest rate on our bond, 10%, is more than what similar bonds are offering as interest rates. So because of that, two things. One, our bond is going to be in demand. It's going to drive the price up because we have a higher interest rate than everybody else. And two, we're going to demand more money up front to make up for that interest difference. We don't want to pay more than everybody else. We're stuck paying more than everybody else. So basically, we're making the bondholders pay for that extra money they're getting up front. So in the end, it all evens out for the corporation and the bondholder. After 6 months passes, we must pay interest. Again, figure out interest the same way. The face value of the bond, $3.4 million, 10% interest rate, that's contract rate, times 6/12, $170,000. Just like a discount on bonds payable, a premium on bonds payable must be spread out over the life of the bond. So we divide the total amount by the total number of interest payments. Again, 10 years, 2 interest payments a year, 20, $39,647 of the extra amount we receive when we sold the bond must be transferred out of that account and now recorded in the interest area. But it doesn't increase our interest expense. It actually decreases the amount of interest. Here's what we're paying. That's what we're locked into. If we subtract the portion that would bring our interest rate down to what everybody else is paying, then we'll truly record what everybody else is. $130,353 is the true amount of interest expense. Now, just a timeout before we see the journal entry to remind you, the premium on bonds payable account is called an adjunct account. It acts like a contra. So it changes its buddy. It has to have a buddy. But an adjunct increases a buddy. Contras decrease because the adjunct is increased on the same side as its buddy. Now let's see what happens with the journal entry. We're going to credit cash for $170,000. Yep, we're paying that much in cash. Now we're going to debit that adjunct account premium on bonds payable for $39,647. And the difference is how much we record as interest expense. And it will continue to be that journal entry each interest payment date over the next 20 interest payments. Take a look December 31st, same exact journal entry. Now, in part 3, they want to know, well, what's your total interest expense over the life of the bond? Well, the 20 payments of $170,000 each will equal $3.4 million. Remember, we're paying out more than what everybody else in the market is. And because of that, we said to our bondholder who was buying that, you're going to pay a little bit extra. So that in the end, we're really only going to be paying out the same interest as everybody else. So decrease the total payments by the $792,932. That will give you the true amount of cost of interest to the corporation, $2,607,068 over the life of the bond. Let's see the impact on carrying value. Again, to determine carrying value, you take the principal of the bond. Now, when it sells for a premium, you add the balance of any premium on bonds payable to get the carrying value. So the day the bond is sold, the unamortized or not recognized, not expensed premium is the amount that was paid above the face value, $792,932. So that forces our carrying value to be at $4,192,932. The face value of 3.4 plus $792,932. Now remember, at each interest payment date, we'll be reducing the premium on bonds payable account. So it's going to go from $792,932 down $39,647. We'll be debiting that account. So now the new balance is $753,285. Add that balance to the face value of the bond of 3.4 million, your carrying value is now at 4,153,285. The same thing happens at December 31st. We go from a 753,285 premium on bonds payable balance, decreases 39,647. You're now at a balance of 713,638. The carrying value of the bond is also decreasing. Take the 713,638 to the face value of 3.4 million. Your new carrying value is 4,113,638. So when you sell a bond at a premium, the carrying value decreases over time from its original starting point. Yes, because the premium on bonds payable is decreasing, and premium is added to face value to get carrying value. So a lot of this is similar to when we sell a bond for a discount, except for that one little component, the premium, and how we account for it. We still amortize it or spread it out over the life of the bond. It's just its impact on interest expense is opposite. It decreases interest expense, where a discount increases it. Okay, so that is two great review problems for how to handle the sale of bonds at a discount or premium. So please post any questions you may have to the discussion board.